Hi, it's Bruce. Today we're going to be discussing CVR Partners, but before we do so, I just want to go through a disclaimer. Turnaround stock investing is not an investment advisor. This content is for educational purposes. Please see the disclaimer at turnaroundstockinvesting.com. Today we're going to be reviewing CVR Partners, symbol UAN. CVR is a leading producer of urea ammonium nitrate, which is a nitrogen fertilizer. I believe that after 7 years of falling UAN prices, we are finally seeing the bottom and a resumption of an upward movement in prices, which could last a number of years. This mean reversion for UAN prices could lead to 100 to 300% return in the stock price for CVR Partners over the next few years. In addition, the recent dividend elimination and current tax law selling makes me comfortable that everyone that wanted to sell has sold the stock. This video will go over the supply and demand for UAN. We'll discuss Carl Icahn's control of the company. We're going to go through the balance sheet, and I've developed an EBITDA sensitivity table, which will show you how the cash flows vary with UAN prices. And then we're going to go over the cash flows for CVR. We're going to discuss risks for the company, especially with its debt that's outstanding. We're going to go through the covenants, and we're going to discuss how natural gas prices can affect the profitability of the company. And then we're going to review the chart and where we're going to enter the investment, stop, and where we would re-enter. This video should take about 23 minutes. Before we dive into the supply and demand, I just wanted to take a brief look at where the stock has been so you get an idea. We're looking at a stock that in 2013 was about $21, and with the declining UAN prices, we can see that it's been driven all the way down to the lows of about $260 here, and it's currently about $320. So I just want to give you a sense of how UAN prices have affected this company and its stock price. Here's just a little picture to show you how UAN is produced. As we saw in the other video with phosphate rock, went in to make phosphoric acid, which made DAP and MAP. In the case of UAN, what you're doing is you're taking natural gas. In CVR, one of their plants, they actually take petroleum coke. But let's say natural gas is turned into ammonia, which is then turned into a urea and ammonium nitrate, which makes UAN. Just to go into a little more detail, liquid urea ammonium nitrate, or UAN fertilizer, is relatively simple to produce. It's a heated solution containing dissolved urea, which is mixed with a heated solution of ammonium nitrate to make a clear liquid fertilizer. So basically, this is a soluble substance which is sprayed on as fertilizer. Now here's a chart to illustrate what's happened to nitrogen prices. They've been falling for the past 7 years, and as you remember in my Mosaic video, I pointed out there seems to be this rule in ag that 7 to 8 years is how long it takes for a bottom to be reached. And the reason that is because it takes that long for producers to finally say, we have to shut capacity. We are the only ones that can control the situation. We can't wait for demand to catch up with supply. And that's exactly what's happening now. So let's take a look at where we've been. Here's UAN prices. This is UAN in the Gulf. So we reached about a price of $400 a metric ton in 2012, and we have now fallen to about, recently it got to about 130, I believe, in the Gulf. That's a huge decline. Here is ammonium in Tampa, where we can see it was 700. It fell below. It recently got into the hundreds here. So this has been a devastating bear market. And the reason this occurred is supply and demand. We've had a lot of nitrogen that has been, a lot of nitrogen capacity added, much more than demand. And this is what happens. Now, this chart is very interesting because it shows us how much UAN is produced in the United States and how much is imported. And you can see that historically, the United States was always a net importer of UAN, and that's represented here in the green portion of the bar. And the blue portion is how much we produce domestically. And what's basically happened is that in 2012, 2013, CF Industries and other producers decided that they were going to expand capacity. And that's what's happened basically here, is that there's been a lot more UAN and urea and other nitrogen fertilizers that have entered the marketplace, but more than demand has increased. This is the reason that you've seen the large decline in UAN and other nitrogen fertilizer prices. Now, the result of this, as you saw in the previous graph, there'll be less imports. That affects other producers around the world. And in this graph, you can see that we received our UAN imports from Trinidad, Russia, and China and Egypt, and that's going to start declining. But of course, there's capacity, right? And that has to go somewhere. So the question is, will capacity be shut down in these countries? So what happens in one country affects others, and that's what's occurring right now. The markets are shifting. This graph shows the UAN cost curve, and you can see that North American producers are the low-cost providers other than these other countries because we have much lower natural gas costs. So what's going to happen over the next few years is that the United States is going to start exporting UAN, and the reason we can export is that our costs are much lower than all of the other overseas producers, as you saw in the previous cost curve. So now going back to the prices for UAN, the market declined so dramatically as it was adjusting to this excess supply. And even recently, participants in the market were even unsure what was going to happen. CF Industries brought a tremendous amount of tonnage into the marketplace just since 2016, and that causes precipitous decline that we saw in UAN. But what's happening now is that the markets, the worldwide markets, are accepting all of this UAN that's produced. There was a fear that it would affect domestic prices, which it did, but that all that capacity would stay in the United States. And now it's being exported. And that's a tremendous relief to the U.S. producers of UAN, and specifically the CVR. Now, just to show you how experts always get things wrong, here's a slide from the 2015 conference on UAN, and we'll take you right to the slide now. So in 2015, this particular expert, we're looking at the UAN Gulf barge price, was anticipating that you were going to see a rebound up to 220. But what happened instead is that it just continued to roll over and go down. You are now at the point of maximum pessimism. Actually, it was reached a month ago where everyone just thought it was continue to go down. But now that we're seeing that tons are being exported and that the pricing is recovering, I think you have reached the bottom. So we're now looking at some charts to show where ammonia, we're going to look at ammonia, urea, and UAN prices are. And as you can, just to illustrate this bounce that we're coming off of the bottom. So here's where ammonia prices were. And you could just see we peaked out here at 600 and it's just been a straight decline. But what's interesting is, as you can see with me with double bottoms, this commodity reached this double bottom, actually overshooted, and then has bounced back. So that's ammonia. Here's urea. We've also had this long decline in urea. Here's the double bottom. And actually, we've overshot the previous high. So this, again, is looking very bullish. And here's UAN. We can see that UAN has just been in this decline. It was actually higher, right? We were at 400 previous year. So it's just been this straight decline. And now we're seeing this break off from this bottom. So I'm pretty bullish here and think that we've reached the bottom because supply and demand is coming into equilibrium. That's the key. And it took 7 years for this to occur. So now, what does this all mean for CVR? So let's take a big picture. Basically, pricing at the bottom came for UAN about 100 and actually lower, and we'll go through the financials. But let's just assume on average UAN price at the bottom was 160, ammonia price 308. And I think right now we're probably going to get back to the 200 for UAN, 400 for ammonia. Now this is per ton what they're receiving. So how did I generate this EBITDA sensitivity model? To basically they're producing 1,000,003 tons of UAN annually, and they're selling 320,000 tons of ammonia. To produce those quantities, you have to generate 876,800 tons of ammonia. That's how the chemical formulations work. So now let's look at the model. If these are the prices that you're receiving and these are the tons you're selling, you're going to generate, in this particular case, 98 million in revenue from ammonia, 212 million of UAN, and there's other revenue. This other revenue comes from other urea products that they sell. Now, the company doesn't break this down. I had to back into this because it's below 20% of their revenues and they're not disclosing it. Basically, it comes out other revenue is 8% of the combined amount of ammonia and UAN. So then I'm coming out with the cost of material. I'm breaking in the direct cost of materials expense by saying that for every ton of ammonia that they produce, which goes into these products, it's costing them $100 in direct material costs. And for direct operating costs, it's $100.80 per ton for every ton of ammonia produced. And so that gives you your cost right there. Each year, there's expenses for fixing and maintaining the plants, which I'm annually assuming is $10 million, and SG&A is $24 million. So that brings you, with this particular price, EBITDA of $56 million. Now, as we get and discuss the balance sheet, you'll see that they are very leveraged and have a huge amount of interest expense. They're paying $64 million a year of interest. And they also, now this is very high, but I'm assuming $30 million in CapEx. Right now, given the conditions of everything, that number is probably down to $5 million or less that they're spending. But just to build out my model, I put in 30. So you could see that they're burning cash. And this is the reason the stock is plummeted. But what happens if prices go back to 200 and 400, which I think is likely? You can see that what falls to the bottom line is enormous. The EBITDA increases to $145 million from $56 million, just from the price increase. All of this price increase falls directly to the bottom line. Now, this is also assuming that natural gas prices stay constant. So you can see that if we get back to 200 a ton for UAN, 400 for ammonia, after interest and CapEx, the company is generating free cash flow of $51 million. Now there's 113 million shares outstanding. So that's free cash flow of 46 cents a share. And I'm assuming if the market prices this at 8% yield, you're looking at a stock price of $6. The current stock price is $3.20. And again, if UAN prices rise to $250 and $500 for ammonia, you're looking at free cash flows increasing up to 157 million, and then 264 million if you get here. I'm not really anticipating that we're going to get up here, but who knows in cycles. But I doubt it. I think that what we would do is probably get around into this area. And given that the market has changed so significantly with UAN, we may be just looking at a mix right between here. But still, you can see where the share price would go. So this is why I'm excited about this opportunity. But again, you have to keep in context what the balance sheet looks like, because this is not a no-brainer. There's a lot of leverage. So time is not on our side. The nitrogen markets have to turn and can't go back down. So here's CVR's balance sheet as of September 30th, 2017. They reported last week. And if you take a look, they've got $625 million in long-term debt and $70 million in cash. So on a net book basis, they've got $577 million in equity. And once again, these plants will generate an enormous amount of cash flow when the cycle turns. But you have to keep in mind that there's $64 million in interest expense. So time is not on your side, given they've got $70 million in cash. Now, if the cycle is turning, which I believe it is, this stock is going to move nicely up. But if I'm wrong or early, which happens in many turnarounds, you'll have to be stopped out eventually, because why? Now let's discuss that. Now here's a slide that came with their earnings presentation. And as you can see, in the last quarter, they only generated $3.6 million in EBITDA. Now there's adjustments here and they say it's 5, but let's just assume it's either 3.6 or 5. You've got interest expense of $15.7 million. And there's CapEx. In the last 12 months, CapEx was not high. It was 2.6 million, but there's something there. They estimate that in 2017, they'd spend $15 million in CapEx. So what this means is that the company has to generate a minimum of $64 million to pay interest and $15 million to pay CapEx, which comes out to about $79 million. So is that possible? Let's go back and look at our EBITDA sensitivity table. Now, if you look at forward prices for UAN and ammonia, right now the prices are right a touch about a little above for UAN, say it's 180, and ammonia, say is 330. So in those circumstances, on an annualized basis, you'll be generating $81 million in EBITDA, which covers interest and CapEx. So I think that we are now in sort of in the safe zone. However, if prices were to fall back, then it's not looking good. So this is why I consider this a great option stock. If it works, it's going to be a huge winner. But if it doesn't, then you're going to probably have to do something. And that's where I want to discuss who the major shareholder of this company is. We're now looking at the third quarter 10Q for CVR Partners. And I may have not mentioned this before, but CVR Partners is a limited partnership. And of the partnership units outstanding, the public owns 66% of the units, and CVR Energy owns 34% of the outstanding units, and 100% of the general partner interest. Carl Icahn owns 82% of CVR Energy, which owns a 34% of the general partner limited interest, and 100% of the general partner interest. Now, typically the big concern you have when you have a general partner is, are they going to plunder the limited partnership units? And I went through the 10K to look at all the intercompany transactions and everything that's going on between the GP and the company, and everything seems to be normal. There's no excessive fees that are taken. Yes, they are using Carl Icahn's global buying operation, which I don't think is silly considering the size of his operations and his ability to purchase cheaply. So I don't think he's taking advantage of the LPs. And I actually think it's an advantage that we have Carl Icahn. He's very contrarian. He understands cycles. So I think that if something were to happen and nitrogen prices were to fall, it's highly likely that he would just have a rights offering, which would be open to all shareholders. But if we were to get to those levels, we'd probably be stopped out of the stock. I'm going to be watching daily nitrogen prices, UAN prices, and the market will also anticipate that too. So it would probably break a base and we would be out. So next, let's just quickly look at what that $600 million in debt is and what the covenants are attached to it. So here's a snippet that I took out of the indenture for the bond issue, because what you want to do with cases of companies that are generating little or negative EBITDA is to see is it possible that the covenants can force a bankruptcy or any other severe hit to the equity holders. And in this case, there's basically nothing. There's a fixed charge ratio which exists, which really just prevents the company from paying a dividend. Because remember, this is an LP, and historically, all free cash flow is just paid out to shareholders or LP holders. So I don't see any threat there. Now, they also have an asset-based loan credit facility, which they have not used at all, which also has covenants as a fixed charge ratio covenant. Now, my suspicion is that, again, if they start to run into problems, Carl Icahn is going to step in. He actually is the credit line to the company. So, again, we'll be out of this situation, but I don't even see, if the worst happens and the cycle stays down, that all of the LPs are going to be wiped out. But in the interim case, I think that we're fine if nitrogen prices stay where they are and just flatten out and move forward. This is not an issue for us, but I want to bring this up so you're aware of it. To go into a little more detail about the debt, there's $645 million bond issue. It's 9.25% coupon. It's a senior secured note. And this was issued in 2016 when they merged with another fertilizer plant. The bond is currently trading at par, which is a good indication that the equity is not a wipeout. The other critical point to make about this piece of debt is that it's due in 2023. So there's no principal payment staring at us over the next few years. And this nitrogen cycle is going to turn within a year. So again, no covenants, and due in 2023. Okay, so let's take a look at the chart now so we can match the fundamentals with the chart. Now, typically, as I've mentioned, I want to see a change of trend before I buy. And on a long-term basis, you can see the stock here at 21. There's been no change of trend. It has not crossed this downward line. But however, I'm not always waiting for that the case to be, because this is a long-term chart. So let's take a look and see what it looks like on a shorter term. And again, if you can see the fundamentals turning, I'm not going to wait for this. Now here's a shorter term chart. And what's interesting is if you look in my book, I talk about the inverted head and shoulders. And typically you'll see that when the market is trying to bottom. So in this case, nitrogen and UAN prices were just absolutely tanking. And we got down to this 260. And of course, the markets move with what's happening with the commodity, in this case, UAN, and there was this recovery that started to occur. And so you had this move from 260 to 360, and then you went back to here, you retested this low, rose again when the earnings came out, and now you're back at this area. So I consider that now is a good time to think about buying between 360 and 280. Who knows where it's gonna be volatile all over the place here. And I would buy in between here, and I probably would not stop out. In fact, I would probably just stop out right around here, but may not. I know I'm hesitant. I would definitely stop out at this level. But this could be volatile again, because I do think that the markets are going to get hit soon. But this is a very attractive opportunity because UAN prices are moving. And UAN prices will continue to move up regardless of what the stock market does. So I do believe that this is something that you just purchase in this area. You buy in partial positions. You buy a little bit here, and it goes down here, buy a little bit more. And again, I'm doing a video now on how you actually take a position size relative to your portfolio, but you know your own capital, and so you can adjust accordingly. But this is how I see it. So I'm going to wrap up this video now at 21 minutes. I didn't think I would go this long. And if you have questions, come to the timeline and ask me questions, and I will get back to you.